Well, g'day there, traders and friends, market participants, and enthusiasts right around the world. Also, an extended welcome to the broader YouTube community. It's great to have you watching this market update. It is as at the close on Wednesday afternoon, a very important market update. The reason for that is because we have seen the markets pull back, but once again bounce off those rising exponential moving averages. What I'm going to do for you over the next maybe 10 to 15 minutes is just break down similar types of patterns which have been, or at least have presented themselves over the past 1 to 2 months, and really what to look for in terms of this bull market advancing or potentially a continued slowdown, if not a correction, as we transition into the second half of August, also further into September 2017. So really since last Tuesday, 2 Tuesdays ago, we were left with this high wave spinning top. Since then, the markets have pulled back collectively. You've seen the Dow Jones Industrial Average lose quite a few points. However, there has been a healthy bounce to really begin the first half of this week's worth of trading. As you can see, there is a gap between that of Friday and Monday's trading session. You can see that we are trying to push on back up and almost reclaim the top or the peak of this high wave spinning top. There is a little bit more distance to go. Now, the same is true for the S&P 500. You can see the similarities between these two charts. Again, you have that high wave spinning top. You see the sell-off back into support on this particular chart. But again, the difference between Friday and Monday has resulted in another gap. Now, obviously, these are air bubbles. They are air pockets. What it is showing is that there is still a resilience of buyers on the Dow Jones Industrial Average and the S&P 500 to be jumping back into this trend as it continues. Now, the reason I'm bringing up these exponential moving averages is because as these sell-offs begin, or as we move into sort of correctional types of waves in the market itself, generally we'll see buying support at either the 20, or if the 20 cracks, it will be at lower levels, more definitively down around this rising 50. Now, obviously the handbrake was pulled on the market Thursday, 1 week ago. Again, we stabilized on Friday, and you see this air bubble, this jump, this gap to the upside. This is, again, people, traders, active market participants willing to jump back in, and they're buying off these temporary pullbacks. Now, what can we deduce really away from, I guess, the sentiment? What is going on with the market at the moment, and how can we sort of, I guess, mold this into some form of, I guess, a structural plan of attack, or really what can we denounce in terms of active trading strategies that we can apply to the market? First of all, with the Dow Jones Industrial Average, when we have seen these similar types of pullbacks, these very shallow, very quick pullbacks, and then the resulting gap, okay, I want you to understand this. You have to see the resulting gap. And the gap I'm talking about or referencing is, of course, the difference between Friday's close and the beginning of trade on Monday. Is that, first of all, you want to see price action overcome the previous swing high. If you see these gaps, they are generally continuation gaps, all right? We assume that they are continuation gaps until the market reverses. If the market exhausts itself, well, then we will start calling that of an exhaustion gap, which gives us a very different type of meaning. Now, again, if we go back and see some of these gaps, you can see, of course, we pulled back. This period, of course, in the month of May is very similar to what we're currently seeing right now at the current juncture on the Dow and the S&P 500. You can see this gap again in the opposite direction over here. What happened? We reclaimed the swing high and the market continued to trend. Now, what is very important right now is that for this trend to continue, and if you're talking about the legitimacy and the sustainability of the trend, you want to see the Dow Jones Industrial Average break above 22,197. If we more or less turn anywhere around this current pivot, we're still trading and we're still holding above that 22,000, that psychological round number. You can see the closing print on Wednesday, 22,024. Now, if we see a reversal around this location, we fill the gap and we start to break the swing low over here, of course, being Thursday's session, Friday's session, well, then that is a major negative for the market. Then we will start to look at this gap in a little bit more detail as to it potentially being that of a reversal gap. Now, again, the same is true for the S&P 500. The gap to the upside, we're left with another doji candlestick during Wednesday's trading session. A lot is on the line for the S&P 500. In a perfect world for the bull market to continue, we'd want to see this more or less crack above 2,500. You can see my trigger here, 2,494. But really what is happening in this type of location over here is something that I don't want to become too involved with. I'm sort of allowing the market to prove to me that it wants to continue its trend to the upside, or at least I am preparing myself, or I am prepared for the market to pull back and to pull on back down into lower areas. Now, what makes me a little bit curious about this price action. Before we move into that, let me just show you that of the NASDAQ. Again, you can see the sell-off after the high wave spinning top over here. This was going back 2 Tuesdays ago. The move to the upside, this coincided, of course, with the bounce off the 50 exponential moving average. So again, once we crack that 20, generally we'll sell off or pull back down into the rising 50, and that will be, again, the trampoline of support. But again, if we cannot overcome this little swing high coming in at about 6,425, and then of course the 6,450 peak, well, then we have to start becoming a lot more aggressively defensive, so to speak, on the market, and at least allowing, of course, the discussion upon lower prices for the markets moving forward. Now, going back into this, and what is relatively interesting is that if I bring up that of the transportational average, you can see for yourself that very similarly to that of the Dow Jones Industrial Average, we have seen the sell-off. The sell-off occurred quite some time before what we have seen of that relevant to the industrial average. And again, I spoke about this. We were talking about the divergences which were setting up and establishing themselves between that of the transportational average and the industrial average. Well, what's interesting now is that the transportational average, it has slowed down. We do have a short-term little double bottom here. That's fine. It's not really that of a precise sort of location on the chart to be really acting all that much. But what we've seen is a bounce to the upside. And during Wednesday's trading session, we've been left with something very similar to that of a gravestone doji, if not a shooting star. And this is generally the location. I mean, I was mapping this out for you to see whether or not we'd see the bounce and to look out for early reversal signals to see if we'd see continued weakness in the transportational average. Really the crux, or at least the reason for this, is to say to you that, look, there are some really concerning candlesticks chart patterns forming on that of the transportational average, which is going to affect that of the industrial average if we see follow through to the downside. Now, my trigger personally on the transportational average for really a sort of a deeper correction is that of just below 9,100. You can see on my trigger or on my screen here, it's 9,087. I'm going to be monitoring what's happening on the transportational average around this sort of vicinity or this location, which is essentially going to give us clues as to the direction of the industrial average. Now, again, if you just exclude that of the transportational average, what I've spoken about in terms of the analysis relevant to that of the industrial average is extremely relevant, and it is very, very pertinent. If we do not overcome this swing high over here, and if we start to reverse more or less from the current location where we find ourselves bouncing back up into, you have to be prepared again for a larger correction, or at least a larger pullback to what we've seen during this very brief sell-off, which took place over about 4 trading sessions. All right, so this is sort of continuing to develop. The clouds are forming, so to speak, and I'm bringing it to your attention. Now, if I continue the discussion into that of the Russell 2000, a very similar type of chart to that of the transportational average, it's sort of a hybrid between that of the transportational average and almost, I'd say, the industrials or the NASDAQ. What we've seen again is sort of a deeper sell-off. We're sort of stabilizing in no man's land. We are slightly above macro support, which is interesting. We're trying to see the bounce, but the bounce compared to that of the transportational average isn't on par. So this is telling us that the Russells at the moment is relatively weak. On top of that, if you take note of this, we're actually below the exponential moving averages, and they have definitively crossed. So price action is below both the 10, the 20, and the 50. So it's something to monitor. And also, we're right smack bang in between, I'd say, the rising 100 and the 200 simple moving averages as well. So there's a lot at stake for the Russell. We have moved down into relatively oversold conditions, but in terms of a really healthy sort of correction, it more so fits in alignment with the pullback down to about 1,350. Now we're printing at 1,383. What I'm not doing right now is really opening up any exposure, either bullish or bearish, into the Russell. What I'm doing is monitoring that of the transportational average, and also very closely the more sort of closely followed US indices, that of the industrial average, the S&P 500, and the NASDAQ at this particular point. Also, if I continue the discussion, we're sort of in a reset sort of phase for that of these markets. I mean, you can sort of see how these oscillators are trying to turn up, or at least the short-term sort of oscillator here in the RSI. The RSI is adjusted, but the MACD is very important. This is telling us that we're in some form of a correction going on with the market. Now, that can mean that the market moves sideways, or we can see a larger pullback. The same is true, of course, for the Dow Jones Industrial Average. In fact, these are all in agreement at the moment. You can see how they're all producing bearish crosses. It doesn't necessarily mean that there's going to be a major correction. It's just telling us that the market needs time to reset, to let these oscillators recalibrate for that next bullish pop to the upside. So again, I've got some very clear, I guess, criteria of what I'm looking for before I do certain things. That, of course, are the markets breaking to new highs. Until that occurs, of course, I'm very defensive on this market at the current juncture. You can see again, if I change to the S&P 500, they are still in a reset type of zone. You can still see they're in alignment to the bearish side, especially the MACD at this particular juncture. So I hope that helps you. If you find yourself not doing all that much in the markets, it is for the best at the moment. The last thing you want to be doing right now is jumping into a bunch of bullish trades, in my opinion, when the market is still 50-50, or at least the odds are skewed that we are going to see lower prices moving forward. Instead, you should wait for the market to align at better areas, better levels, better locations that you define or predefine prior to price actually hitting. And then, of course, you are well prepared to take advantage of the ensuing bounce or the ensuing breakdown once we see further confirmation in terms of chart patterns and also candlestick patterns as well. And, to start seeing some of these changes in direction of the underlying exponential moving averages and long-term simple moving averages as well. So I wanted to wish you an enjoyable Wednesday evening. I'll be back with you on Thursday to recap the market action. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Goodbye.